Do you think there's still room to run for mega cap tech?
Hi, and thanks again for having me. We actually have been moving into a more balanced stance over the last couple of months, and we're really focused on the growth versus value collision course, if you will, that's set up for 2025, among other actually, precarious collision courses across our macro economy and also for markets. So we've moved into a more balanced stance because we look at growth as this as dominant really over the marketplace for really since the great financial crisis minus a few years, most recently in 2022. And that latest phase, of course, has been moved by AI spending, the story. But you question at what cost does that come at? Are we looking at valuation that grows into infinity? And what point does that price in the scenario that we're in now? Also, the growth that's to come over the next couple of years. Also, at what cost does this AI spending and this productivity come? Of course, that's a boon to earnings, but does it come in wage gains and workers that could cause a little more consternation among the consumer and consumer spending? So we're balancing all of those right now, and it led us to a more balanced approach is how we look at the U.S. markets and not preferring growth over value any longer. And we actually had been in that stance for several years prior.
Well, when it comes to big tech and when it comes to the Magnificent Seven, I think a lot of people would agree with you on these stretched valuations. But the pushback I keep hearing to that point is that you have the earnings growth to back it up, that basically the fundamentals are justifying these eye-watering valuations. And if you expect to see some of the momentum behind big tech fade, are you saying that you would expect earnings to disappoint a bit in 2025?
Not necessarily. That's why we haven't gone underweight in growth. We actually are just in a neutral stance, if you will. We don't see the case for that disappointment to come in 2025, even 2026. As we grow into, like you mentioned, earnings have grown into multiples that seem lofty, a year and a half ago, don't seem as lofty anymore today. But that maturation of this growth phase of investment has to come at some point where the market prices in fully the bolus of spending that's flooding this marketplace. Again, we don't feel like these stocks are broken or any the part of the story is amiss at all. But we think that growth actually could come more in sync with value as far as the performance over the next couple of years as the market digests those valuations in time.
Well, let's talk a little bit more about value because, of course, value has broken a lot of hearts over the past couple years, and many expect that to continue. So you have the valuation piece looking good when it comes to a lot of these value names, a lot of these value indexes, but are you expecting to see actually that earnings growth broaden out, especially if we are in a higher for longer sort of environment where the Fed can't cut as much as maybe some had been hoping?
It almost has to, and we've looked at this closely. From a bottom-up standpoint, the market expects earnings per share growth of 13% over 2025. That's not as concentrated in the Mag 7 as it was in 2022 and 2023, and especially in 2024 as well. So that broadening has to occur, and the valuations just don't show that broadening is expected. If you look at names like financials have started to appreciate some of that, and those stocks have performed over the past 12 months. We're looking at other spaces like that offer the opportunity for the valuations to grow into a broadening of earnings growth that the market expects from a bottom-up standpoint, but from a top-down standpoint and also from an index standpoint, really hasn't materialized in a lot of those value names in those industries that traditionally are categorized as value-oriented. And so we're really excited about just the balance that earnings growth could lead to performance in value sectors. And we feel like growth doesn't necessarily have to bleed out in order for that to happen.
Keith, over the last couple of years, really since the public introduction of ChatGPT, we've seen a lot of the AI gains go to just a handful of companies, including the mega caps, hyperscalers and whatnot. I'm wondering when we're starting to see those AI gains go to other types of companies. Like, when is AI going to allow Procter & Gamble to sell more Tide and toilet paper with fewer people?
We're starting to see actually some implementation of AI that could benefit sectors and names and industries outside of the Mag 7 already. You see that in healthcare. They're starting talking about how some development of drugs has accelerated, and they feel like they can be more efficient in how they allocate resources because of artificial intelligence they've implemented within those platforms. So again, that's the spending comes first, the productivity gains come next, and we should see that materialize across the board. Again, that's a case for the spending, of course, will grow to those names that put this technology and implement this within the economy. But as all industries start to implement some level of higher productivity, that benefits names across the board, and those with lower valuations, in theory, should have a quicker move up when those earnings start to accelerate.